Good afternoon, everyone. Today's video is geared more towards our options traders. So in today's video, we're going to be doing a deeper dive into 6 stocks, and we're going to track different options pricing. The 1 days to expiration option series, so the ones that expires tomorrow, the weeklies, compared to the 8 days to expiration options, which are the monthlies expiring next week. We're going to look at each of these with their respective returns for tracking what would have been our normal stock volatility box move using the actual underlying. So this should give us an idea of, is leverage really useful? What kinds of stock does leverage work on better than others? And it should give us some idea around this expiration cycle and which expiration to use for which type of trade. Now, today we had a total of 90 long entries. 71 of those were via our aggressive volatility box with a winning rate of 53.52%. And then via our conservative volatility box, we had 19 trades with a win rate of 94.74%. Now, keep in mind, both of these are just the raw models without even our confirmation signal indicator. So once you layer that on top, we see that number, at least with the aggressive, jump up much closer towards that 60 to 70 range. And with the conservative, we can already see that the number's in the 90s as it was today in terms of accuracy on the volatility box models. Now, the other point that I'll call out is this repeated pattern now that we've seen, which is our trade expectancy is positive between the 6 a.m. to 10 a.m. Pacific range. So this is the first few hours of the market open. That's where we have enough time for follow through, especially when you are taking part in some of these volatility box fades. So here's a list of all 90 long entries that's set up today, but in particular for this options deep dive, we're going to focus on the following 6. XRT, which is our retail ETF, Baidu, Uber, and then on the right hand side we have Salesforce, Walgreens, and then PDD. And these are the 6 that we're going to track via options. And so if I now move on to the next slide here, we should get an idea of what we're looking at. So with our 8 days to expiration option series, for XRT, we used the 43 call with 8 days to expiration, and this is the strike. This is the entry price at the time of entry when we had the breach. This is the price once we hit that first gray target line, and then the P&L as a percentage based off of our entry price. So for our retail ETF, we had the 43 call. Our entry price was $1.05, but we didn't really see the option move a whole lot. That only went up to $1.06, and that was at most. And that's just being a little bit generous, where you had a return of 0.9%. So XRT didn't really move a whole lot. Then if we take a look next at Uber, we used a 32.5 call. This was 8 days to expiration again. $1.10 was the entry, and the option once we hit the target was worth $1.25. So a decent return there, 13.6%. Now Baidu, we used a 132 call. 275 was the entry. 287 was the exit. Again, 4.3%. So if you're comparing this as a percentage move, it was mediocre, especially when you're considering using options on the leverage of 100 shares. But you'll see how we improve this. So CRM, the 200 strike had the most liquidity. $2.30 was the entry. 295 was the exit. And Salesforce in both tests was a model in which the options moved and tracked fairly well with the actual underlying. And so that's where we saw a nice 28.2%. Then on PDD, we had our 90 strike call, $3.90 for the entry, $4.11 for the exit. So a total of 5.3%. Again, fairly mediocre. And then finally, Walgreens, 38.5 strike. The options were 91 cents at the point of entry, $1.10 at the time of exit, so a total return of 20.8%, and that's as a result of the options being cheap. And again, here we're not factoring in any commission, so that's something else that you would want to factor in. But based off of this, we see that Walgreens and Salesforce were our 2 best options in terms of where we got the best return off of the actual options pricing. Now, if we take this one step further, so now instead of 8 days to expiration, let's try and narrow this down to 1 days to expiration. And the only reason why we're comfortable using 1 days here is because these are meant to be day trades. You're not holding any of these options overnight, so that theta decay is not something that's working against you if you do hold it overnight. And so as a result, you're able to try and play some of these moves and have cheaper options in which you have the Greeks working in your favor for the purposes of the day trade. So now if we compare this with that 1 days to expiration cycle, here I have the same symbol. I tried to use the same option strike wherever possible, which was the case in all of them outside of our retail ETF where we didn't have a liquid enough strike. Then I have the same entry price, the exit price, along with the P&L. But then you'll see that there's one more column here, which is our delta compared to the 8 days to expiration option. And before we even go down this line, what you should notice is that 1 days to expiration option, your delta in terms of how much more do you make as a return percentage across the board in 5 out of these 6 stocks, or at least the 5 that we could track, is in double digits if you do narrow down your time frame and use the 1 days to expiration options series, where the options are not only cheaper, But if you're right, you get this move disproportionately in your favor where your returns are exaggerated in a positive way, which is beneficial to growing your account, especially if you do have a smaller account. So with Uber, for example, the 32.5 strike call was 45 cents at the time of entry, 62 cents at the time of exit, which was a P&L percentage of 37.7%. And if I contrast this with the cost of the 8 days to expiration series, this option, instead of being 45 cents, was worth $1.10. And so you'll notice there you were required to pay $110 for that trade, and here you were required to pay $45. So substantially less capital required, and off of that capital, you were able to at least put that capital to be a little bit more efficient for the purposes of a day trade. Now Baidu, same call, 93 cents here, and this was compared to $2.75 in the 8 days to expiration series. And that's where we saw this 93-cent option went up to $1.15 for a total return of 23.6%, where our delta there was 19.3%. And what you should notice is Uber is where we had the highest delta in terms of 1 days to 8 days to expiration series. And then across the board down here, you'll notice that this gradually decreases based on the type of stock also that we get to. So now if we move on to Salesforce, our option here was 55 cents compared to $2.30 in the 8 days to expiration series. And that jumped up to 81 cents for a total return here of 47.2%. There we had a delta of positive 19%. Then we had PDD, where the option was $1.38 compared to $3.90 on the 8 days to expiration, which jumped up to $1.65 for a total return of 19.5%. And there we had a nice bump up higher compared to what was a mediocre return. This was the 5.3% on the 8 days to expiration series. And then finally, Walgreens, where we had our option was 42 cents and worth 55 cents at the time of exit. So that was a total return of 30.9%. But our delta here was the lowest with a 10.1% delta. And that was a result of, again, the Walgreens options in the 8 days also tracked fairly well. So our takeaways here are Walgreens and Salesforce both did a much nicer job, at least if you're trying to use the options in lieu of the underlying, to use the additional leverage that options give you as an alternative to the actual stock, because here you'll notice that getting a 47% return on your capital, at least with the actual underlying, is close to impossible off of a day trade. But using options now, you can suddenly see how you can start to deploy your capital in a more efficient light. Now let's get to the charts of each of these just so we can get an idea of each of these trades visualized. But some of the takeaways here should be, again, liquid options, using 1 versus 8 days to expiration series, and using the strike, which has the most open interest or volume, where you know that you don't really have to play this battle with trying to guess what the options price is. It does a fairly decent job of tracking the underlying just because there's enough volume trading along the way. All right, so starting with the charts of XRT, our retail ETF, and we'll go through this kind of quickly. We're on a 1-minute chart, and using our aggressive volatility box models, our setup is we wait for price action to breach our volatility box edge. Once that happens, we're waiting for an edge signal. Once we get that edge signal confirmation, that's our entry to get in, looking for a price at our clouds or better. Stop is outside of the volatility box, and our target is at the gray target line. Now, what you should notice, or at least observe as we're going through these charts, is where price action continue to drift up higher into the rest of the day, because that's where you'll also understand, because that's where you can start to see where this 1 days to expiration option can very easily double or triple in value, which again starts to give you some higher probability ways to play some of these lotto type moves in quotation marks. So now with our retail ETF, once we had our entry, we had our edge signal, we had an opportunity to enter at the clouds or better, and we made our move to the actual target. But this happened fairly quickly where the options again didn't reprice fast enough, and only the 8 days to expiration options were the ones that were liquid enough, and that's where we saw only a marginal gain of $1. So now let's move on to Uber, which was a little bit more interesting. So off of Uber, we had price action hit our volatility box edge. At this point is where it hits our live scanner for all of our volatility box members. We then saw our edge signal right here. It's hidden behind our low bubble, but that's where we had the edge signal plot. And we had our opportunity to enter at the clouds or better. In fact, we had a better opportunity to enter. And at this point, again, the trade is now valid. We're waiting for our target, which is at the gray target line. Stop is outside of the volatility box, which if I bump this up a little bit, the stop was outside of the box. And what you should notice is once we hit that first target, our stop is now at break even, but Uber continued to again drift up higher into the actual close. And if we look at that same option that we were looking at, the 1 days to expiration option, the 32.5, let's see what that closed at just to get an idea there. So the 32.5 closed at between 78 to 89 cents, which at the time of purchase was 45 cents. And so that should give you an idea. Again, that was an easy double where Uber moved close to 3% from the point of entry, where the volatility box lets you time that entry. But this is where, again, using that 1 day to expiration options gives you this disproportionate move up higher and rewards you at least for trying to have some of these levels. Now, if we move on to Baidu, very similar setup here. Breach of our volatility box, got the edge signal, had an opportunity to enter again at the clouds or better. And at this point, we hit our target almost right away. So Baidu, very similar. We didn't see the options price as well as it could have. But if we notice what this option's tracking into the close, where again, we drifted up higher, the option that we bought for 93 cents, this was the 132 call. And that's where it was now worth 134 to 180. So that 93 cents was close to doubling if you did get the ask. But let's use the mid price there, where you'll still see, again, a much nicer gain than even our great target line. Now, Salesforce, we came towards the edge of our clouds, which just made this a much nicer setup in terms of risk. Our entry came once we got the edge signal, which was deep inside of the clouds, but the stop was still outside of the volatility box. So our risk there was much, much lower compared to what our potential reward was, which was handsomely rewarded. And so in the case of Salesforce, we saw that our 55-cent options, once we hit our target, again, Salesforce just continued to drift up higher from there. If I measure this from our actual point of entry, once we got our signal, that was close to 2.53%. Now, if we use that same 200 call option in that 1 days to expiration series, that was this guy right here. You'll notice that now went up to 159 by 195, which was purchased for 55 cents. So that was almost a quadruple. And that's where, again, just this is a repeated theme with Salesforce, where Salesforce options seem to do a really good job whenever we do hit the volatility box in terms of giving you a better alternative to trading a $200 stock. Now, if I keep going down the line here, PDD, very similar theme, right? We had price action breach our volatility box, multiple edge signals, opportunity to enter at the clouds or better, and then we made our move to the actual target. Now, in the case of PDD, we didn't really see that same follow through, right? Instead, if we actually draw this as a line in the sand, our target line, you'll notice that we really just chopped in between, came back down to our clouds, came back up to our target, shot a little bit above for our close. And if we do take a look at that same option in that 1 days to expiration, this was the 90 days, now trading for $1.44 by $1.80, which at the time of entry was $1.38. And so you should notice there that that option was worth less than our actual target, which was $1.65. And that's where you saw that as we kept the option here, it just continued to erode value as PDD didn't really make a move up above. But what you should also notice is you weren't negative, right? $1.38 was still worth at the very least $1.44 into the close. And so that's where it should give you confidence in the idea of having a break-even stop and being able to see how high is high. And then finally, the last option we had was WBB. And this is where we did have earnings, and typically off of earnings, we're using the conservative volatility box. So just full disclosure, this is a super aggressive trade, but for the purposes of options, we do have liquid options here. So it made for a very interesting addition to the study where we had, again, price action breach our edge. You had the edge signal not once, but 2 times. And from our point of entry, you'll notice, again, you hit our target, came back down, hit our clouds, which did stop all break evens for the actual shares, but then continued to bounce up higher from there, where if you do take a look at the WBA options, we were using 38.5s, and this was trading at 65 by 80 cents into the close, which at the time of entry was worth 42 cents. So that should give you an idea of, again, what it looks like to hold these 1 day to expiration options when you do get some of these nicer disproportionate moves, where you did get an opportunity to quote unquote buy the dip, and what that looks like using the volatility box in conjunction with some of these shorter dated options. All right, hope this video was useful for all of our options traders. Should give you some insight into, again, how to use leverage, along with having theta work in your favor, where you now have risk to reward skewed in your favor, and you have the opportunity for some of these nicer wins, like the Salesforce, where your 55-cent option is now worth $2 into the close. All right, take care, good luck trading, and we'll see you in the next update.